Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas, but you got credit concerns and you're wondering if you can actually qualify and buy? Stick around. In this video, I'm going to teach you every credit tip you need to know. You know, I help a ton of people with home loans, and the word credit comes across my desk multiple times a day. What is credit? Why does my auto score, my credit card score, my credit expert score, my credit karma score, my Vantage score, why are all these things not the same? Why are there so many models? I don't know what to do. Should I pay my credit cards off? Should I close my balances? You know, what do I want to do? And so these are questions I get all the time from consumers out there. So I want to go over a couple things around credit score myths, credit busters, things that cause problems with credit, things to do, things not to do, and how the credit score affects the overall approval of the loan and the interest rate, okay? So what I want to get to into part one is how the credit score affects the loan. Then I'm going to go into part two on this. Then I'm going to go into part three, things you should do. So number one, home loans are really looked at and graded for each person based on four things, really. Credit score is going to be number one. Down payment is going to be number two. Property type, number three. Occupancy type, number four. So let's go into down payment. So the down payment, basically there's a grid and it says, hey, the more money you put down, the better the deal. So 5% down, 10% down, 15% down, 20% down, all the way to whatever you want to do for a down payment. The biggest risk-based adjustments that affect an interest rate in the down payment are between 5% down and 20% down. 20 to 30 is a little bit better, and then once you get to 30, it's pretty much all the same. But down payment is a component of it that obviously affects the interest rate, so the more money down, the better. The second one is the credit score. So credit scores range, they range from worst case scenario 350, best case scenario 850, but on a credit grading scale for home loans, really they run from like 620 to about 740. Now there are a couple that want to do 760, but let's just call it 620 to 740. So the way that it works, you'll hear what's called LLPAs. It's a fancy term in the mortgage business for loan level price adjustments. And so for every level, you get a price adjustment. So what does that mean? Well, they get graded in like 20-point increments. So let's say it goes 740 is the top, then 720, then 700, then 680, then 640, then 620. And for every 20-point increments, you get a loan level price adjustment. Think about it as an adjustment to the interest rate, not in your favor, meaning going up for every 20-point increment. So from 740 to 720, it's going to adjust up, let's call it an eighth. 720 to 700, it'll adjust up a quarter. 720 to, 700 to 680, it'll adjust up a half, and so on and so forth, sometimes to where, it can be anywhere from 1.25% to 1.75% on the interest rate itself based on FICO score. So credit is huge, guys, when you're applying for a home loan, because credit in a lender's eyes shows your ability to repay your previous debts and how much you honor your word. If you have not made payments on time, there's a risk there. You've got a low credit score because you haven't paid things on time, and so therefore that lower score is not going to give you a competitive rate, just like somebody at the top who gave themselves perfect pay history, because it is a screenshot in time. That's what we have to go off of. Third one is property type. So there are three real property types in buying a house. There's a single family home, there is a townhome, and there's a condominium. If you're buying a townhome, it's riskier than a single family home, and if you're buying a condo, it's riskier than a townhome and a single family home. So there are interest rate adjustments for property type as well. Occupancy type, I think I mentioned this, but occupancy type is it going to be your primary home, or are you going to live in it full time? Is it going to be your second home, aka your vacation home, or another primary home that you visit and stay at, you just don't stay full time at, which are normally, the word second home should really be vacation home. It's kind of like lake house, beach house, ranch house, farmhouse, things like that. Now, it doesn't mean you can't have a second home, aka a vacation home. It's not in a natural vacation area. You just have to make sure and explain to us why. That can be I'm a season ticket holder, I travel to Michigan 6 times a year, I've got work in Austin, I go back and forth all the time, so you can still get a second in a vacation home when it's not in a vacation area, but you have to explain it to make sure it's not going to actually be a full-time rental. But the occupancy type has something to do with it. And lastly, on the occupancy type is an investment property. This is a property that you're buying that is a full-time rental. You don't plan on being there at all, and you're going to rent it out full-time to tenants. So again, the occupancy type. Primary is the best, secondary / vacation home, and then obviously investment property. So all these are blended together when you have somebody who's putting together a home loan. So hey, what's their credit score on this sliding scale? How much down payment? Are they buying a condo? Are they buying a townhome? Are they buying a single family? Are they going to live in it as their primary, secondary, and or investment? And then when you squeeze all these things together, this is what ends up being where the interest rate is spit out to the consumer based on what's called a matrix and all these mixed together, these risk-based adjustments. So credit scores are really the one that most people can affect the most, right? Because you kind of know what property you're going to buy. Probably a house or a townhome or a condo. You know it's going to be your primary residence for the most part if you're buying it as an owner occupied. The down payment piece, it might be adjustable, maybe 5 to 10% down, but it's not going to be a whole lot. But where people can move the needle a ton and it makes the biggest adjustment is on the credit score. So I want to go into part 2 about the credit score piece. So I want to talk for a little bit about models. I won't bore you forever on this, but there are a ton of different credit scoring models. They are all FICO models and credit scoring models, but they're not all the same. So if you want to know what the difference of the models is, what your auto scores are versus your mortgage scores versus your credit card scores versus your Vantage scores versus things you see online, you can go to myfico.com, set up one of the profiles, and you can take a look at it. It'll tell you what the different scores on all 3 bureaus. And what I like about myfico.com is it shows you exactly what the scoring models are for any financial institution you're going to potentially go get a loan from, and you'll be able to see the exact scores on all 3 bureaus before you go apply with them. So if you're going to go do an auto loan, go on there and say, get me my auto scores. It'll pop up and say, hey, your auto scores are 720, 726, 749. Great. You know all 3 of the auto people are going to see, so there's no funny business with them. And obviously they will use middle score, blended score, whatever it is for the interest rate in the car. But the same thing applies on home loans, credit cards, and all that. So don't be confused with all that, but the scoring model and the data are a little bit different on each. While they should be similar in nature, meaning your car score and your credit card score and your mortgage score should all be within probably 30 or 40 points of each other. They won't be exact because they're not the same model, and it all depends upon the bureau that you select as well. So a little 101 on that. A couple other small things about credit that are myths, and then things I'm going to help you out with to get your credit score in the right direction. Paying all your bills on time is the only thing that will help you get your credit score in the right direction. Incorrect. Your credit score is a mix of payment history, type of accounts like a mortgage account, a revolving account, which is a credit card, an auto account. So the mixture of the type of accounts that you have factor into it. Age is a big deal. With credit, sometimes when you're young and you've got a couple credit trade lines and you've paid them all on time, you could be a 750, you could be a 760, that's great. But in order to get to the 800 or the 850, there's just something in the credit model that won't get you there without age. I will tell you, in most financial institutions, if you're a 740 or higher, 760 for sure, you are considered an A+. So if you go get a home loan or an auto loan or a loan that's, a rooms to go loan, if you're a 760 versus an 850, you're not going to get a better deal from 760 to 850. You're eventually an A+, and so if you get to a 760, even if you want to achieve an 850 for yourself, there's no change in rates, but sometimes to get to 850, age is something that you just have to wait. Credit scoring model wants to see a long history and a long period of time, and so if you don't have that, even though you may have A+ credit, you're not going to be able to get that 850 that you desire. But again, 760 should be the mark, as it's pretty much A+ in every financial institution. Credit card balances based on the limits. So this is what's called a utilization. So easy example, if you've got $1,000 credit card limits, ideally where you want the balance is 8% or low. Some people will say 30%, some people will say 0. Neither one of those are fully true. 30% or below will keep the FICO score from going up but 8% is ideally where they want to see it. So there's something about the 8% sweet spot. So if you're ever obviously going to get a home loan, you want to do that to improve the FICO score. If that's the right move, call me to do a consultation. We'll get those balances down to where they need to be, and obviously it can push the FICO score up a lot. Credit card balances based on where your limit is a huge piece of where your score will end up. Sometimes I've seen people pay in their balances 50, 60, 70% and boost their FICO score 100 points. So there are a lot of things that you can do there with me and through our team to maximize getting your FICO score to the peak, so that way you get the best interest rate. If you have any collections, the dollar amount of the collection does not affect the outcome of the negative item on the report. So if you have a collection, let's say you have great credit and all of a sudden you have a medical collection from a year ago pop up for $100. That $100 medical collection is going to have the same outcome as a $1 million medical collection. The collection piece on the credit report is just looked at as a derogatory. Hey, it's a derogatory item, it popped up a month ago, it's recent, it's negative, that's where the effect comes. So the dollar amount doesn't change the impact that it has on the score. The dollar amount is just how much you would actually have to owe that collection company in the event that you paid it, but whether it's $1 or $1 million, it's just more about the negative item. Those negative items in some cases, do not pay them in full and close them out to start out with. If you want to pay them in full, that's fine, but you should contact the creditor directly or a credit specialist or an expert and talk to them about doing what's called a pay for delete. A pay for delete is, hey, this medical collection popped on, I am not admitting fault, but I will pay you in full in writing for you in exchange for you to delete this from the bureaus like it never existed. Because if you've got a 700 credit score, collection pops on, probably going to pull your credit score down to 650. If you just pay that collection to zero, you've paid it down to zero, so it can't hurt you anymore, but it still won't reverse the effects that it had on the 650. Where if you have the 700 and the collection pops on, it drops you down to a 650 if you call them and make the payment in full, but you haven't agreed pay for delete. What happens is that collection literally gets deleted from the bureaus and the credit report like it was never there, and it'll automatically boost your FICO score up to 700 where it was before. Last piece, people talk about authorized user accounts. So authorized user accounts can be a great way for somebody to improve their credit score, their credit profile, and their pay history if they are added on to somebody else's account. So this is designed for two people that are together, right? Partner, husband and wife, whatever it is. Two people get married or they do life together, and let's say, for instance, I have a credit card. I'm married, I add my wife onto the credit card as an authorized user, so we both have access to it, and now I'm buying groceries, she's buying groceries, we're paying bills with it. Well, any history that I had with American Express prior to my wife being added, when she gets added on as an authorized user, it will automatically link her to the American Express account, give her all the back history that I've done with that account, for better or for worse, but assuming it was all positive, that will feed into her FICO score, and now all that pay history that I've had for 4, 5, 6 years will feed into her profile and boost her score. So this is a benefit of being an authorized user on account. Again, it's not to misrepresent the FICO score, but one of the imperfect things about the algorithm is when you're added on as an authorized, you get all the prior history associated with the person that you're piggybacking on top of. That also goes for worse though. That person gets a late payment, that can affect your FICO score. So these are some things I want you guys to be aware of when buying houses, but again, credit is one of the most important pieces. There's a lot of confusing information out there. You need to be focused on what to do to get your mortgage FICO to the highest peak possible. And hopefully this video and these tips and tricks obviously will help you understand the trueness of how things work, how to improve your credit, and how to get yourself in the best possible position from a credit score in order to get you the best interest rate possible when getting a home loan. So listen, I hope you found this credit video useful. If you did, do me a favor and drop a comment below, like, subscribe, even share it with somebody that you know that could benefit from this information. And if you want to have a conversation with myself or the team around the future of your pre-approval, set up a mortgage planning session with me. Call me, email me, text me. We're always here for you. Until next time, stay tuned.